Assalamualaikum and greetings to Doctor. We are from Group 3 of OCC1 and today we will be presenting our summary of reports on our selected companies of Sime, Darby, Berhad.
Now, we are moving to the brief history of Darby. Darby was established in October 1910 and it is a government-linked company which its headquarters in Ala Damansara. It operates as a diversified conglomerate covering sectors such as industry, automotive, healthcare, and more. Darby is well known for caterpillar products, heavy equipment, and service used in mining, construction, forestry, marine, and oil and gas industry. Overall, Darby play a major role in plantation, property developments, industrial equipments, automotive, and energy utilities. Now, we are moving to the Darby key market segments. The first market segment is industrial segments, which provide rental and servicing of heavy equipments for industries such as construction, mining, forestry, and oil and gas. The second segment is motors, where Darby operate a multi-brand automotive businesses covering assembly, distributions, rentals, and after-sales services. Last but not least is UMW divisions, which focus on equipment, manufacturing, engineering, and aerospace. Together, this segment highlights Darby's strong and diversified business portfolio. For this session, we would like to evaluate Darby performance over 5 years. This comparison conducted from current to past ratio performance, which enable the management to spot the trends. Any significant changes may indicate a problem and require the management action to address the issues. We are moving to liquidity ratio, which show the company ability to meet its short-term obligation. The highest working capital in 2023 does not completely show the efficiency or liquidity of the company to cover its short-term liabilities. It can be interfered that might be a less liquid asset and more current liability in 2023. The years of 2021 had the highest current ratio, asset test ratio, and cash ratio compared to other observed years during 2020 to 2024. The years of 2021 had the strongest ability to meet its short-term obligations. The declining trend in liquidity ratio may implying that Darby might decreasingly rely on its liquid asset like cash, saving, and its accounts receivable. Now, we are moving to Darby's ability to meet its long-term obligation. From 2020 to 2022, Darby was financed more by equity than liabilities, indicating relatively conservative capital structures. However, in 2023, total borrowing increased sharply from 376 million to 2,246 million. This significant jump was mainly due to the acquisition of UMW, which was financed 90% through borrowing and 10% through internal cash. As a result, the company time interest earn ratio peaked in 2021 but declined thereafter, reaching its lowest level in 2024. This decline reflects substantially higher interest expenses arising from increased borrowing and obligation to the financial institution. Moving to Darby equity ratio, Darby recorded its most favorable asset utilization performance in 2021, where the company effectively used its asset to generate higher sales and revenue. This was also supported by the shortest average collection period, indicating efficient receivable management and strong cash inflow. This performance was largely driven by the economic recovery after COVID-19 lockdowns. However, in the years that follow, the company experienced slower inventory turnover and longer collection periods, suggesting reduced operational efficiency. This trend continued eventually worsened in 2024, reflecting slower sales growth and delayed collection.
Hello, I'm Pok Sombat. I will talk about the profitability ratio analysis. So obviously, the table and graph shows the increasing trends of net profit margin, return of asset, and return of ordinary shareholder equity over the period of time. But at the same time, gross profit margin was slightly decreasing year by year until it reached the lowest point at 2024 because the higher operating expenses. And as reported in the statement of profit and loss year ended June 30, 2024, it shows that net profit doubled from around 1,500 million ringgit to 3,500 million ringgit. The reason is the company has received gains from disposal of joint ventures by selling shares of the RSDH, which is the previous Sime Darby healthcare investment. Next, you can predict the future growth or future performance of Sime Darby by interpret the market ratios. The high earning per share and price earning per share in 2021 could reflect the future expectation as the firm would have a strong performance and future growth of the firm. Moreover, the highest point of earning per share was in 2024, that was 48.5 cents. However, high earning per share in 2024 does not guarantee the long-term performance as the sharp growth of the earning per share was likely due to the large gain from exit of the market of healthcare industry, which is just the current gain.
For this section, we focus on evaluating the cost of capital of Sime Berhad for the year of 2024. The cost of capital representing the minimum rate of return the company must generate in order to satisfy both of its equity investors and also debt providers. In other words, it is an act as a financial benchmark for determining whether the company is creating value or merely covering its financial costs. So therefore, this analysis is important from an investor perspective as it reflects the returns expectation of capital providers given the company risk profile and also capital structure. Therefore, by analyzing the cost of equity, cost of debt, and also WAAC, this section provides a structured basis for evaluating Sime Berhad's financial efficiency, investment attractiveness, and its overall ability to generate sustainable value. This slide focuses on capital structure of Sime Berhad, which is a key input in determining the company's overall cost of capital. Capital structures refers to the mix of debt and also equity financing used to fund the company's operation and also investment. As at 2024, Sime Berhad has a total capital base of approximately 51.8 million, comprising of 54% debt and 45% equity. This indicates that the company relies slightly higher on debt financing than equity, resulting in a moderate leverage capital structure. However, capital structure must also be assessed from a risk perspective. Excessive reliance on debt could increase financial risks and also pressures on the cash flows. In Sime Berhad case, the current level of leverage appears to be manageable and consistent with its diversified business operation, which supports its stable income and also generations. Now, without further ado, let's move on to the cost of equity. The cost of equity is estimated by using the capital asset pricing model, or known as the CAPM, which links the return required by the shareholders to the company's systematic risk, measured by beta. The risk-free rate is 3.19%. Is measured on the Malaysian 6 to 12 months treasury bill rate as at the 31st December 2024. The expected market return is also calculated throughout the period of 2020 to 2024, which turns out to be 2.52%. Hence, by using the regression analysis, Sime Berhad's beta is approximately to be 0.31%, indicating a defensive risk profile with a lower sensitivity to market movement. As a result, the estimated cost of equity to be approximately 2.98%, reflecting a conservative return expectation under subdued market condition. Now, let's move on to the cost of debt. Next, we estimate the cost of debt, which represents the return required by the lenders for providing financing to Sime Berhad. The pre-tax cost of debt is estimated by using the build-up approach, combining the risk-free rate and also the debt risk premium, resulting in a pre-tax cost of debt of 5.19%. Since interest expense are tax deductible, we adjust for the corporate tax of 36.3%, which reduces the approach to 3.31%. This relatively low after-tax cost indicates that Sime Berhad is able to access debt financing at favorable rates, reflecting manageable credit risk. That's all from me, and now I will pass the floor to my colleague to explain to you guys on the WACC calculation.
Our team calculated the weighted average cost of capital using cost of debt 5.19%, after-tax adjustment of 36.3%, and cost of equity 2.98%. And the WACC is around 3.16%, which is relatively low. It reflects company defensive risk profile and efficient use of debt financing. Therefore, as long as the company's operating returns exceed this rate, it can create value for its capital providers.
Now we are moving to the interpretation of circularity market line. The circularity market line is used to support and justify our estimate cost of equity and resulting investment decisions. Between 2020 and 2024, the SML slopes downward due to a negative risk market premium, reflecting a prolonged market uncertainty that caused by COVID-19 pandemic. During this period, the investors show a stronger preference for safer assets, leading towards lower expected return for higher risk investment. Now we are moving to the conclusion. Sime Berhad operates with a relatively low financial hurdle. Using CAPM, the cost of equity reflecting a defensive risk profile driven by low beta, a negative risk premium, and downward sloping SML during 2020 to 2024 period. The after-tax cost of debt estimate a 3.31%, indicating a favorable borrowing condition, and the company WACC is estimate 3.15%, and the conservative return expectation suggests a limited short-term upside. Therefore, our investment recommendation is to hold.